Hello everybody and welcome to Green Star Trading with me Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, for the next few minutes we're going to be looking at the SPY, which is our proxy for the S&P 500. We'll be looking at our Elliott Wave count and some basic technical analysis as always, but today I want to start by looking at the bigger picture, zooming out and having a look at the whole bull market because there are some interesting levels, Fibonacci extensions, Fibonacci retracements, and relationships that I want to point out. And then we're going to come in and have a look at the more recent count. We had a little bit of a down day yesterday, just about 125 basis point drop. Nothing serious yet, but it could signify the wave 3 that we've been waiting for, the primary wave 3 could be in, and that's a possibility. So we're going to come and talk about that in a little while, but first I just want to come out to the weekly time frame. And we're going to take a look at our count from the bottom of 2009 up to present day. Now what I've done is I've recently been in the process of reformatting all of my charts and bringing them into line with one another. If you are an analyst yourself and you've been doing it for many years, you'll end up with hundreds, perhaps thousands of charts recorded, and eventually once in a while you have to have a big purge, and that's what I'm going through at the moment. I'm simply purging all of the unnecessary copies, bringing everything down onto one chart with a single backup, and then working from there. So what I've done here is I've repackaged everything into neat little folders in my object tree so I can pick out what I need when I need without it being too cluttered. So this is a process I'm currently undergoing for all of my charts. It's going to take a little while to fully update them all, but I'll get there eventually. So the first thing I want to do is I just want to strip away the Elliott Wave counts. I have one from the March 2020 low and I have one leading up to it. And I just want to look at some interesting levels here. So the first thing we're going to need is our, bear with me one moment, we're going to need the count up until the 2020 low here because we're using cycle wave 1, 2, 3 and 4 to help project cycle 5. So first thing I want to bring up are some interesting levels I've noticed. So let me just find them. I have okay, so here's the first level that I find quite interesting, which is 100% of cycle 1 from 4. So if I take the length of cycle 1 here and project it from cycle 4 here in a log scale, I get this number here, 446.20, slightly higher than that actually, just ever so slightly. And then we have my labeling here saying 100% cycle 1 from 4. Now this is a typical Elliott Wave target for wave 5 if we get an extension in the wave 3, and we did get an extension in the wave 3. So on a log scale we've literally come straight to target and reversed in the last day. Now I'm not suggesting this is necessarily the top of the market, as in the wave 5, and that my count of us going potentially higher in the future is wrong, but there is the possibility of that. So on that note, I've also produced an alternate count which gets us to this level 1, 2, 3, 4. This is using the idea of an expanding triangle, but it really doesn't matter where the 3 is. The 3 could be here or the 3 could be over here. Essentially what matters is where we're taking our measurement from the wave 4. And we take our measurement from the wave 4 and it gives us this target here, 100% of cycle wave 1. So in order to make sense of this, I've had to couple it with a count from the 2020 low, which would allow us to complete up here. And this is a count I was originally working on many months ago of a very small primary wave 1 and 2 down here. This was the 3 and 4, and all of this huge move here has been a wave 5 extension, which is just completed and is now going to roll over, and this would be, you know, the top of the market in this case if this alternate count is correct. Just an idea. I'm not particularly giving it any particular weight at the moment. I just find it curious that after such a long period of time we've come straight to this level here at 446. So also if I look at some pitchforks for a moment, that's the one for the market, that one's a different position. That one's for the wave 1, 2 in cyclical. So yeah, here is it's always the last one, isn't it? So here is the pitchfork I'm using for a wave 1 and a wave 2 in log scale to project the overall market. So 1, 2, 3, 4, we had this throw over here in the 3, all the way down to the bottom of the channel in the 4, and we've roughly come pretty much straight to the extreme bound again, the extreme outer bound. We've never been here before, so right at the extreme outer bound here, right as we bump into this level of cycle wave 1 from 4. Okay, so it's just an interesting area of resistance. It doesn't necessarily mean it's the top of the market, but it's just an interesting area of resistance, because we could easily come down here into a wave 4 that I'm predicting and come up to test this outer bound, or even perhaps a much higher target, for example the one we have over here, which is the 61.8% extension of 1 and 3 from 4. So taking the whole length of the 1 and the 3 and projecting it from 4 brings us all the way up here to 543 spot 54. So this is a significant area of resistance we've just hit, but it's not necessarily the top of the market. It could be, but it could just be, like I've been suggesting, the idea of a 3 into a 4 and then another push up, in which case this level would become more interesting once, if and when we make new highs, and that would support the primary count. So let's just remove those levels for a moment, remove this alternate count, and let's come back in and have a look at the current count and see what sense we can make of this. So let's zoom in and we'll do some catching up with our current Elliott wave here. So working on the assumption that the alternate count is not correct, we didn't have a primary 1, 2 down here and a primary 3, 4 down here, then the best candidate which I've been working on is the idea that the high in September was the primary wave 1 and we bottomed in primary wave 2 also in the same month. Okay, and then everything since has been working on a wave 3. Right then, so we have a couple of targets here also with another set of levels, and this is here called 1 equals 3. So 1 equals 3 is 460.52. Now what this means is that the length of our primary wave 1 is equal at this level, 46.52. So if we've topped in a 3, and I say if because it's not certain, but if we have, then we have a shorter wave 3 than we do a wave 1. This in turn places a limit on where the wave 5 can potentially end up. Now it's not as significant as, small limit, because the length of the wave 3 is still substantial. Even when projected from wherever the wave 4 ends up, we could still end up with a very significant wave 5. But it does place an upper limit on the 5 if this does turn out to be the primary wave 3, because the wave 3 can never be the shortest. So if it's already established itself as being shorter than 1, it can't possibly be shorter than 5, and therefore 5 must complete before the length of wave 3 projected from 4. It's just an Elliott wave rule that has to be obeyed. We also have a wave 4 invalidation down here at 358.76. This is the top of our primary wave 1, and this shows the potential for a wave 4 correction, if we have completed a wave 3, to come basically anywhere down to this level but not break it. Unlikely that we would come that deep, I feel, if we have completed the primary 3. I think we would likely stop before then. Why do I think that? Well, if we look at some of our geometry again, we can pick up our pitchfork for the wave 1 2 pivot here, which has contained all the future price data up until this point, still is containing it. And you can see how even inside of here we still have multiple levels and areas of support. Now depending on where you place this pivot, you can place it like this also, suggesting that this would be a WXY correction 1, 2, and then we'd have to move everything up a wave degree. Or you can place it as I've placed it. Here's my primary count, which is 1, 2 into a 1, 2, so on and so forth, 3, 4, 5. Both look pretty good, really, to be absolutely honest. Both seem to channel and provide support at certain areas and contain all the future price data up until this point. So until we see this pitchfork broken, completely broken, I wouldn't particularly be suspicious of any downside move. There's plenty of room at this wave degree to maintain a wave 4 correction if that's what we are currently in. Now, we will know soon enough, because if the market continues to break down and take out all of these previous highs and lows within this structure, and if it takes out the wave 4 lower intermediate degree, that would be confirmation that we are in a significant or a greater wave degree correction at primary degree. But we've got a long way even to the extreme outer bound of the fork here. We could fall and still remain within it and still have a very significant correction in the wave 4. And on that note, I have a couple of levels to look at. So let's just hide this again. These are two fib retracement areas for a wave 4 at primary degree. We have 23.6, which is 417.17, and we have 38.2% at 398.67. These are the typical retracements for a completed for a wave 4 retracement after completing a wave 3, and that's based off of taking the length of this whole move here for 23.6 and 38.2. So once again, if we just bring up our pitchfork, you can see how the 23.6 could bring us through the pitchfork and down outside of this outer bound, and the 38.2 could bring us all the way down to the extreme outer bound and potentially out of it. So it's not that uncommon, since when we're pivoting off of a 1, 2, we're looking for the completion of the wave 3. So the 4 could complete within it, or it could fall significantly out of it. The only rule that has to be obeyed is that it does not transgress upon wave 1's price territory, which completes at 358.76. Excuse me. So as you can see, potentially a long way down before we invalidate this count, but these are the likely targets. With how bullish this market's been, we don't necessarily even have to make it this low. It's just been that every dip gets brought, and we have very small retracements, so we don't even have to come down this low, but we could. It's possible. So let's hide those levels again now. Do we have any? So that's the fibs. Alternate count I looked at. What levels of these? That's that level which shows the wave 1 from 4. That's the count. Okay, so let's just dig in now into what we think is happening. So as you can see, I've stripped down the charts really. I've had a few, well, not complaints, but observations that the charts are just too busy, and I agree. You know, there's no point putting minuets, sub-minuet, micro corrections and impulses in. It just dirties up the chart. So I've kept it down to an absolute minimum here. So what I think is happening since our intermediate wave 4 correction to here is that we've actually been working on something called an ending diagonal into our 5th wave. So what we'd expect to see in an ending diagonal is a series of 3 wave structures, zigzags specifically, where we will come up and do a series of 3 wave moves which will take the form of zigzags until we complete, and then we will fall and break this wedge pattern. So all of these can be counted as zigzags. 3 wave move into a 1, 3 wave move into a 2. If we just come down to a smaller time frame for a minute, 3 wave move into 1, 3 wave move into a 2, 3 wave move into a 3, 3 wave move into a 4, and 3 wave move into what could be the 5th wave. So another characteristic we expect to see of an expanding diagonal is that each successive wave in the structure is larger than the prior. So easily enough to measure, we can take the length of our wave 1 and make sure that our wave 3 is greater than it. It comes beyond the 100%, so that checks out. We then need to check the length of the depth of our wave 4 and make sure that is greater than the depth of our wave 2. So we can come up, take a measurement there, and see that we go beyond the 138, almost 1618, the length of wave 2. So that checks out, and therefore, if this is the 5th wave, this should be longer than the 3rd wave, because each pattern is getting longer. So if we come up to the top of the 3rd, down to the 4th, we can see that we go beyond the length of the 3, beyond the 100% as well. So structurally checks out, wavelengths check out, and the final thing we should expect to see in an expanding ending diagonal is that the 5th wave should complete before reaching the trend line of the wedge from the 1 and the 3. And I would argue that we've seen that here, so we haven't made it up to the trend line. We've got a longer 5 than the 3, that checks out, deeper 4 than the 2, longer 3 than the 1, all of that checks out, but we shouldn't It's not a rule. As a guideline, we don't tend to make the upper trend line in the fifth wave. We lose momentum before reaching it. So if this is the completion of a 3-wave move into a 5, then we have failed to reach that trend line. We met all of the conditions for a ending diagonal. So really from here, it's all about what price action does. If price action breaks down out of this wedge, after completing this 5-wave move of a series of zigzags, having met all of the conditions for an ending diagonal, then we can be bearish and assume that we are in a wave 4 correction and that primary wave degree 3 has completed around this strong fib target here, which we've been looking for, and we are now going to break down. And the wave 4 should, in theory, counter in terms of alternation the wave 2 at primary degree. Now we saw a zigzag at primary wave 2, so primary wave 4 should take on a different form from a zigzag. Now if we topped out in a 3, it is way too early to suggest what that form would be, other than it won't be a zigzag. So possible options: you could have a regular flat pattern like this, you could have a combination which could look something like this, or take a series, as long as it was a free structure. Another flat pattern would be an expanding pattern where we came down, back up beyond where we went, and then down further. All of these are possibilities. But if this is the correct identification of wave 2 as a zigzag, then this will not be a zigzag. If we do see a zigzag develop, something like this, and complete and reversal, that would be a sign that we've mislabeled the wave degree. So if we did see a zigzag correction from here, a significant one that broke this structure, then I would suggest that this is still correct, but our assumption of a wave 3 would be incorrect, and therefore intermediate degree could be moved up to here. To accommodate that, we would then have to reassess where we are in the count. It could even be a wave of lesser degree below intermediate, perhaps minor. Depends on how far this structure could advance, and it could continue to extend. We know for a fact that we haven't reached 100% of wave 1 yet. That's that target here at 460. So the wave 3 could be complete now. We could have completed with this ending diagonal, but this could be an ending diagonal in a smaller wave degree. Only time's going to tell. Only time's going to tell. So I'm still expecting a top here, as I've been suggesting for months now, to top out sometime during the summer. I think we might be starting it now. It's a little too early to say, but we cannot be certain of the wave degree until we see the completed correction. So trading this from a perspective of Elliott Wave Trader, if you're a member of the Patreon and you've followed the education series of the standard trade setup and Elliott Wave series, you'll know that you're simply looking for a 5-wave move down and a 3-wave move back. So it doesn't matter what time frame you're on, that's the initial setup you're looking for. So the way I see it, however, if I'm being absolutely honest, is I'm not interested in trading the correction here, to be absolutely frank, purely because from an Elliott Wave perspective, we've already had a zigzag ABC 535. If this is a 333, it could take the form of a double zigzag, which is a 535, which you could trade as an Elliott Wave, as a standard trade setup. However, if we are going to come back and reverse on ourselves, could be quite tricky. So as Elliott Wave traders, obviously we prefer to trade wave 3s up or down. Now as and when the market eventually does top out, whether there is the possibility of it's topping out here like we discussed with the alternate count, if that's the case, you would see 5 waves down and 3 waves back, and that leaves us with the possibility that either we've miscalculated and this is a zigzag of a smaller degree, or a much more bearish scenario which the alternate count would accommodate, which would be a 5-wave move down and a 3-wave move back into a 1 and a 2. But that would signify a far greater collapse in price. So that's the way I see things at the moment. We may have completed an ending diagonal here. We seem to have a completed structure. So now let's throw up some basic technical analysis and see what we can see. So first thing I'm going to do is hide all of this and bring us back to a naked chart. Bring up the MA ribbon. Now what I'm using here, instead of having my independent moving averages set up as exponential moving averages, I'm just created a ribbon of them. This is a feature that one of my members on the Patreon just informed me was available. Apparently it's quite a new feature, something that I've missed. If I just type, you can see it says new in the little yellow oval here. So this is a feature that's come along to a bit recently to TradingView that I haven't actually noticed myself. So thank you for bringing it to my attention. I can't remember your name, unfortunately. Something knowledge was your tag, I remember. So very appropriate name. Either way, thank you very much for bringing it to my attention. I can now just use this one tool to represent all of my moving averages. So let's come out to the weekly time frame and see what we're dealing with here. We're also going to bring up our momentum indicators. Okay, so we have our 4 exponential moving averages, 10 in yellow, 20 in blue, 60 in orange, 250 in green. We have our RSI set to a 10 close with the green 30 level representing oversold and the red 70 level representing overbought. We also have a MACD with a 10 for the signal and a 20 for the average. Okay, and that's in respective blue and orange. So on the weekly time frame, let's zoom in and have a closer look. Hide our favourites bar for the moment. We're still well above the 10, the 20, the 60 and the 250. So like I said, 125 basis point drop going nowhere yet. So shouldn't be jumping to conclusions. There could be a potential completed structure which we talked about with it ending diagonal, but we have to see that play out and break that structure in order to have confidence that it's completed. Right, so from here we can see that there is divergence on the weekly time frame again. So this keeps coming and going in the S&P. We get this move up and back, move up and back, move up and back, and then occasionally we end up in a period or an area where we have divergent RSI readings. So we can see here, if we look at the RSI in detail for a moment and full screen it, this is 2020. So the recent move here between these two highs shows the high of May to the current high of 9th of August. There's a high and a lower high. If we come back off of the RSI for a moment, we can see how during that same time period, prices continue to climb higher. From a high to a higher high, we have a high and a lower high. It's not the strongest divergence, but when you make the RSI full screen, it is noticeable. So there is divergence back on the weekly time frame. We can see also on the MACD we have the same story. We just zoom in and have a large look at the MACD for a moment. We can see that from the same time period, May the 3rd, to this recent crossover here where the blue line has crossed up and back down over the orange line, and the red bar appearing here on the histogram on the weekly time frame, we have bearish divergence again. So this is likely signifying some kind of top. It could be a longer term top, it could be a shorter term top, but we have divergence here between these two highs. Okay, so let's come down to the daily time frame and see how things look on the daily time frame. So a little bit more bearish on the daily time frame, having broken through the 10 and the 20 exponential moving averages, closing below it. Pre-market currently trading below yesterday's close as well, but we'll have to wait and see. It's still a few hours before the market opens. Now, as you can see here, throughout this previous trend, ever since we had this pivot here, which we said was our wave 1 and our wave 2, the wave 2 retracement went through the 10, 20 and the 60 exponential averages, followed by the next wave 1, 2 of a lesser degree which did the same, 10, 20 and 60. So once we established that, we were then in an uptrend, and as you can see within that wave 3, this uptrend that is still intact, we have stayed above the 60 exponential moving average for the whole time. So this would be another clue we'd be wanting to look for. We'd be wanting to see a breakdown here through the 60. Okay, if we break down here through the 60 on the daily time frame, that would be a pretty strong indicator that this trend off of this swing high, swing low pivot, all of this trend completed something here, and we're now correcting that greater trend. Okay, so let's have a quick look and zoom in on the RSI again. So we can see here we do have divergence on the shorter time frame on the daily. You could call this a triple divergence because we have a series of highs here where we have some people would like to call all the way back to here to September 2020, but the thing is, as a rule, I consider once we have a completed structure that looks corrective in price and it's supported by a move in RSI which supports that corrective structure. If we have a completed corrective structure which takes us all the way to oversold, I consider the RSI reset from that point. Okay, on the time frame I'm looking at, because otherwise we could just go back forever and keep picking out highs. We have not returned to oversold conditions since this completed correction back in September to November, right? So all of this is trading in a range in a singular wave, a wave which may now have completed. So any divergence we look at has to be over the shorter term, and it has to be without that reset condition. We have a free wave divergence here between the high in April, the high in July, and the current high yesterday in the 16th, or sorry, it says the 16th of August, but yesterday's trading is really what's really accelerated this downwards. So we do have triple divergence here, therefore we have divergence here as well. So there is weakness, underlying weakness in the market currently. If we look at the MACD, it's the same, basically the same gig. We have this long-term divergence between these highs, this high back in April, this high back in July, and the current high where we've got this little turn into a red bar on the histogram. But we also have high in the short divergence in the shorter time frame between these two highs as well in the MACD. We also have a little, I'm not quite sure, let's just check. We haven't quite broken the trend here in the MACD, so that would be another sign. If we get darker red bars here on the histogram, break through here after getting this sell signal, that could also be a sign of a greater correction to come, as this has been a single move over several months. Right then, so that's basically the basic technical analysis done. I don't think there's anything else I really want to look at. Let me just have a quick think if there's anything else I wanted to share. I share the alternate count, the idea that the market has topped at that significant level of 1 from 4. If that's true, this will break down violently, and it will break down with a 5-wave move. 1 and then into a 2. So that would definitely be a short opportunity which you're not well, it's up to you whether you trade it, but you can't really afford to miss it. If you see a completed 5-wave move down here and a 3-wave move back up, I think you're obligated to try and use the standard trade setup. This is not trading or financial advice, but if you remember, that's what I would do. But that's only if we get that impulsive move off of a high. If we see a 3-wave structure form and then another 3-wave structure, it's likely that we're observing a correction to the current count, the primary count, rather than this alternate. Okay, is there anything else I wanted to look at? Let's just have a quick look at the volume profile. I forgot about this earlier, and see how it lines up with some of these possible corrective moves. So we really want our fib levels up, which is levels 3. So we can see here, if we have completed a wave 3 at primary degree with this ending diagonal, then we have a big node of volume right here, and the peak of which is bang on the 23.6% fib. We have a gulf where the 38.2 is. Interesting to see what this would be. Somewhere between the 38.2 and the 50, I suspect. So let's just throw up one more fib level. Have we got the one for... Okay, did I even bother with it? Yes, I did. The 50 is back here, but that takes us below the 250 exponential moving average, and we didn't correct through the 120, through the 250, even when we put in a wave 2. So this would be very dramatic if we came down that far. I'd find that would, I'd reconsider what we were looking at if we came down that deep. It is around our point of control, roughly from the whole of this trend upwards though, so that's also interesting. So let's just pop in a wave. Let's just pop in, sorry, the 50% fib. Okay, we now hide this one. Let's just turn off our ribbon for a moment, it's distracting. What we'll do is we'll pop a price label on here, and we'll lock that in place, and we will lock the line in place, and we will also label it. We use our corresponding colour so we instantly know what we're looking at. 50, oh no, I'm typing the interval, don't want to do that. 50% fib. Okay, and we'll lock that in place. And now what we'll do is we'll take our new drawings that we're throwing on here, not the brushes, and we'll put those into, hang on, let's just double check where they are. These are levels, yes they are, so we'll take our new drawings and we'll drag these down, put them into our levels 3, and now in theory all of our levels are now in one thing. So there you go. Let's just delete these two brush scribbles here. So yeah, there are areas of support below us, one around the 23.6 around this big volume node here. There's a huge, well, it's not huge, but there's a really significant gulf here with no sell side activity at all. I don't know if it's a glitch in the chart, it could be, but it just looks like I mean, it was drawing this gap. See, there's a gap here, right, that hasn't been filled, and that gap here which hasn't been filled signifies, lines up perfectly with this gulf in the volume profile, so maybe that gap is significant. So what we'll do is we'll just put a line here as well, put this in green the gap, there you go, lock it in place, and we'll just say gap, because you know, gaps often, as I've spoken about this several times, gaps get filled. It's really quite a frequent occurrence. The problem is it never really occurs on the time frame people expect it to, so gaps often get forgotten about. I've noticed people are like, oh, the gap never got filled, and then it takes 6 to 18 months later it gets filled, and then they've forgotten that it was ever there, and it's no longer relevant to anyone's analysis. So we'll hold it here because it could be relevant, and we will add this to our levels since it's a likely target that we will retrace to. So let's pop that in this one. Yes, the gap's in there now as well, which is around the 38.2 in this gulf. If we go through the 23.6 and we are, I'm not saying we are, but for certain, but if we are retracing in a correction now and we are heading lower, any move through the 23.6 exposes the price to potentially testing these lower levels, because this gap now becomes the next target. It's above the 38.2. There's unfinished business down here because of the gap and because of the volume profile. There's no tested price levels in here, no market acceptance. So you'll either find support toot sweet, or you won't, and you'll just bypass it immediately. That tends to be the case. So you'll either come down here to find market acceptance, or you'll just get instantly rejected. So a significant breakdown could accelerate if it goes beyond this level. Right, I've done enough waffling now. Sorry guys, I know I've got to take it on for quite a long time. Because I'm using this new format here where I'm basically sorting out all of my drawings, I'm re-familiarising myself with these tools since I've been really lazy and not using them in the past. So it's taken me a little while to get familiar with it again. So anyway, there you go. If you're new to the channel, you like what you're seeing, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Leave us a comment in the comment section below if you want to. Thank you as always to my Patreons. Your support is greatly appreciated. Thank you for also being patient with me while I update all my charts. I know I haven't got them all out into the Tom's Charts channel yet, but once I've gone through this process of updating all of my asset charts, I will. Right, if you're not a patron yet and you're interested in becoming one, please check out the link in the description below. Have a look at the tiers, see if there's anything interesting to you. There's lots of great benefits. And if you're not following me on Twitter yet, there's a link to my Twitter feed also in the description box below. Alright guys, thank you very much. Take care. I'll be back with you soon. Bye bye.